Welcome to the deep dive. Today, we're jumping straight into the Q3 2025 earnings for Prologis, that's PLD.
Yep.
We're focusing on the big headline beat, their updated guidance, and this huge strategic move that's really reshaping things for them.
Yeah, it was definitely a powerhouse quarter. And I think there are two main things you really need to grasp here.
Okay.
First, the numbers, they really do suggest the market's stabilizing. And second, this whole data center expansion, it's not a side project anymore. It feels like the core growth driver now.
Absolutely. Let's start right there then with the Q3 financials. What was the immediate reaction? Did they just sort of meet the forecast, or was it a genuine surprise?
Oh, it was a genuine surprise, no question. I mean, the execution was really, really tight. Look at the EPS earnings per share.
Yeah.
Prologis reported $0.82.
Okay.
The street was looking for, what, 67 cents?
Yeah.
So that's a massive beat, like a 22.39% positive surprise.
Wow. Okay. That's quite something. And what about just pure revenue? Did that keep up?
Revenue was solid, yeah. Came in at $2.05 billion. The projection was $2.03 billion, so slightly ahead. But, for REITs, what you really need to track is the cash flow engine.
Right, the core FFO.
Exactly, core funds from operations.
Let's pause on that for just a sec because not everyone listening might follow REITs day to day. Why is core FFO the number we zero in on, maybe more than traditional earnings?
That's a great point. Standard GAAP earnings for real estate companies,
Yeah.
they often get skewed by things like depreciation, which isn't actual cash leaving the building.
Right.
Core FFO, well, it strips that out. It shows you the real recurring cash flow that's actually available for paying dividends, for operations. It's kind of the ultimate durability metric. And Prologis delivered $1.49 per share there.
Ahead of expectations, too.
Yep, ahead of expectations.
I also saw they reported an adjusted number, $1.50 per share, excluding net promotes. Now, that's one of those terms. What are net promotes, and why do analysts pull them out?
Right, so net promotes are basically performance fees. They earn them from managing certain investment ventures with partners. They're great when they happen, obviously.
Sure.
But they can be lumpy, not necessarily recurring every quarter. So to get a clean look at the steady cash from just leasing out warehouses, analysts often back those out.
Okay, makes sense.
And the fact that the $1.50 number, the cleaner core number, was also ahead of expectations, that really shows the underlying operational business is humming along nicely, even without those extra fees.
Okay, so with a beat like that, especially on EPS and core FFO, the market must have noticed. What happened with the stock price?
Oh, yeah, definitely noticed. The stock jumped 7% right after the announcement, shot up to $122.98.
Wow.
Which is trading pretty close to his 52-week high, actually. And that reaction tells you something, right? It's not just good quarter. It signals the market believes these guys can maintain growth, maintain margins, even with, some softness in logistics and higher rates. It speaks to the quality, really.
Okay, quality and execution. So let's shift to the forward view then, because delivering one good quarter is one thing, but they actually raised the targets for the whole year.
Exactly. And that's maybe the most critical piece here. They didn't just keep the momentum. They projected more momentum. They bumped up the full year core FFO guidance again. The clean number without promotes by 2 cents.
Okay.
The new range is now $5.83 to $5.86 per share.
And they also lifted the GAAP EPS guidance too, didn't they? To $3.40 to $3.50.
That's right.
So this confidence, this bullishness, it must be backed by something fundamental, like same-store net operating income growth. How did that look?
Yep. Same store NOI guidance, which basically tracks the health of properties they've owned for over a year. That got raised too. It's like saying their existing buildings are generating more income.
And I see they break that down cash basis versus net effective basis. Why is that distinction important for understanding performance?
Yeah, that's fundamental for real estate. Cash basis, which they raised to 4.75% to 5.25% growth, it's the actual cash rent collected today.
Okay.
Net effective growth raised to 4.25% to 4.75%, includes that cash rent, plus how things like free rent periods or money spent on tenant improvements get spread out over the lease term.
Ah, okay.
In a strong market, both are usually good, but the fact that both got raised here suggests they're getting good starting rents and not having to give away too many concessions. It's healthy.
And that financial strength seems to feed right into this narrative about a market inflection. What did the CFO actually say about where the logistics market is right now?
They were pretty direct. The CFO said the market has, quote, found its footing, which suggests, stabilization after things cooled off a bit.
Right.
And crucially, they said the stage is now set for an inflection in occupancy and rent. They think things are turning back up.
And is that just optimism, or is it backed by the supply situation? Because that seems to be tilting in their favor.
I think it's backed by the supply side, yeah. They're projecting U.S. market vacancy will peak around 7.5%. Manageable. But the really key part, new construction starts are running below pre-COVID levels.
Interesting.
So you've potentially got demand improving, which we'll touch on with leasing, meaning less new supply coming online. That's usually a recipe for rent growth, exactly what they're betting on.
Okay, now here's where I think it gets really fascinating, almost mind-bending, actually. We have to talk about the data center business. It's clearly not a sideline anymore. They're positioning it as this massive value driver.
Yeah, this is the big strategic pivot. This is what could really change the long-term valuation story. Prologis is basically becoming a huge player in, utility-scale power delivery.
How big are we talking?
They now have 5.2 gigawatts GW of power capacity. That's either secured from utilities or already in advanced stages, like construction. 5.2 gigawatts.
Wow.
To give you a sense of scale, that's enough electricity to power millions of homes. It's enormous. And they added 1.5 gigawatt just in this last quarter alone. The speed is incredible.
That speed naturally brings up the money question. They're putting an estimated $15 billion potential investment value on that 5.2 gigawatts,
Right.
which is already a huge number. But then they say it could go up 4 times if delivered turnkey. What's the difference? What's the $15 billion for versus the potentially $60 billion turnkey?
Okay, let's unpack that. The $15 billion estimate, that seems to be for delivering what's called a powered shell.
Okay.
So Prologis uses its land, gets the big power hookup sorted, builds the basic strong, building the shell ready for data center equipment. That's still a major undertaking.
Right.
The value jumps potentially towards $60 billion if they deliver it turnkey. That means they do everything. They install all the specialized high-cost gear inside, the cooling, the power distribution, security, everything. It's fully fitted out, ready for servers.
Much higher margin, presumably, but also more capital.
Exactly. Higher margin, but way more capital intensive and frankly more complex execution risk. The fact they're even floating that $60 billion potential number shows just how serious they are about capturing more of that value chain.
And the demand seems locked in. They said something like, every megawatt we can deliver over the next 3 years is already in dialogue with customers.
Yeah, that quote is stunning. It basically implies 100% pre-leasing for everything they can build in the near term. It just screams scarcity.
Scarcity of what? Land, power.
Scarcity of power-ready land near the major data routes, which is exactly what Prologis has in its land bank. These are essentially build-to-suits for the biggest tech companies on the planet who desperately need power for AI and cloud growth. It's a supply problem, not a demand problem.
Which then leads to how they plan to pay for all this. If you're talking $15 billion, maybe up to $60 billion, that's not coming just from the balance sheet, right?
No way. Not without straining their credit ratings or starving the core logistics business. So they explicitly said they're exploring additional capitalization strategies.
Meaning things like?
Things like setting up dedicated data center funds, bringing in financial partners in joint ventures, maybe selling off completed stabilized data centers to recycle capital. The key strategic insight they shared, though, was this.
Yeah.
They believe the main constraint going forward won't be capital. It'll be getting access to power.
Wow. That is a fundamental shift for a company like this. If power access is the bottleneck, not money.
Exactly. It makes their huge land bank, especially sites near substations, look incredibly valuable. It's less about just square footage, more about kilowatts. They're monetizing the land's proximity to the grid. It changes the whole game.
Okay, let's quickly circle back to the sort of bread and butter logistics business that's funding this expansion for now. Operationally, things look strong there too. Record leasing.
Oh yeah. The core business was firing on all cylinders. Record leasing almost 62 million square feet signed in Q3 alone.
Huge number.
Which pushed their overall occupancy up 20 basis points to 95.3%. And they made a point of highlighting quality there. They're outperforming the average U.S. market occupancy by 290 basis points. That's the flight to quality you hear about.
And that high occupancy lets them push rents when old leases roll over. Talk about the rent change numbers.
Right. So on new leases signed in the quarter, the average rent increase was 49% on that net effective basis we talked about.
49%.
Yep. And 29% on a straight cash basis. Even 29% cash rent growth is incredibly strong. It shows how much higher current market rents are compared to leases signed maybe 5 years ago.
Which brings us to the mark-to-market idea, the sort of hidden value in the existing leases. What's that number, and why should you care?
So the mark-to-market, or MTM, it's the gap between the average rent they're collecting across their whole portfolio now versus what they could get if all those leases reset to today's market rates instantly.
Okay.
At the end of Q3, that gap was 19%.
So if they collect $100 now, the market rate is actually $119.
Pretty much, yeah. And that 19% isn't just theoretical. They translate it into dollars. It represents about $900 million of extra net operating income.
Wow.
It's $900 million that's basically locked in, expected to flow through to the bottom line over the next few years as those older, cheaper leases expire and get renewed at current higher rates. It's a built-in growth engine.
And on the development side, are they building on spec or mostly pre-leased?
Mostly pre-leased, which reduces risk. Build to suit, where they build specifically for a tenant who's already signed up that was 2/3 of their development starts in the quarter.
Smart.
And they expect BTS to be over half of their entire development volume for the full year. So they're primarily building when they already have a customer commitment. Very disciplined.
Any geographical highlights? Where's the strength and where might things still be a bit soft?
Latin America is really shining. Mexico and Brazil delivered the best same-store growth, probably benefiting from nearshoring trends.
Makes sense.
Domestically, they mentioned the tone in Southern California is improving, but rents there were still described as kind of soft. That market often leads the cycle up and down. Other areas like the Southeast Texas seem pretty robust still.
Okay, one last operational point, customer sentiment. What are they hearing from their biggest tenants? Is it still about cutting back space?
That was a really interesting, subtle point they made. They said the conversation is shifting away from just pure contraction companies shrinking their footprint.
Okay.
Now, they're hearing more about reconfiguration consolidation strategies, which basically means companies are optimizing their networks, maybe closing a couple of older, smaller warehouses and consolidating into one new, bigger, more efficient Prologis buildings.
And why is that a positive signal?
Because network optimization like that, it takes planning, it takes capital investment, it signals confidence. When the biggest, most sophisticated companies start doing that, it suggests they believe in their own future growth enough to commit resources again.
Ah.
And historically, that kind of move by the giants often comes just before smaller companies start expanding again, too. It reinforces that inflection point idea.
Right. So putting all these pieces together for you, the listener, what's the big picture? The Q3 results, they really confirm the core logistics business is solid, stable, performing well. But the really big story, the game changer, is this aggressive strategic move into data center power. It points to potentially massive long-term value creation that could fundamentally change how people view the company.
Absolutely. And, it feels significant that this was the final earnings call for their longtime CEO, Hamid Moghadam. His 112th call, apparently.
Wow.
As he moves to executive chairman, his parting message was basically that he believes the best years of Prologis are still ahead of it. Coming from him after decades at the helm, that's a pretty powerful endorsement of this new direction.
It certainly is. Okay, so let's leave you with a final thought to mull over. We heard the traditional logistics mark-to-market is 19%, representing maybe $900 million in future NOI baked in. Now, layer on top of that the potential $15 billion powered shell value, maybe up to $60 billion turnkey value from that secured data center power capacity. If Prologis successfully uses funds or JVs to build that out, how much could that total embedded value, the logistics upside plus the data center potential, actually be worth in, say, 5 years? And will investors start thinking of Prologis less like a warehouse landlord and more like some kind of hybrid infrastructure utility?
That's the billion-dollar question, isn't it? Or maybe the $60 billion question. It's logistics meets real estate meets the power grid. That land, already wired up, suddenly looks exponentially more valuable. That's definitely the calculation the market's going to be trying to make.
Food for thought indeed. Thanks for joining us for the deep dive. We'll catch you next time.